Airbnb loans have been probably the highest
Oh, the
defaulting
worst
loan
performer.
in
Worst performer.
in yeah, in all of the market, right? And especially a lot of clients that bought with very, very little margin in terms of cash flow, right? They're not even breaking even. They bought an alligator, as you might say.
Hmm.
And
Exactly.
because they bought that, they can't carry now the payments. It's 3 years of payments that they've carried.
Last week, we heard from Convoy Home Loans that they had a fund that was allowing, get this, folks, DSCR loans at 5.875%. In that video, we said, or at least I guessed, that the allocation would go fast. So it's been 7 days. I got to know, is all the money gone, or is it still possible to get 5.875 on a DSCR loan? I think it's wild, but is it still available?
It's absolutely still available, and I think the key here, we've actually had 5.875 available for a long time, if you remember, but you don't like it, but it's the ARMs, right, that we had
Yeah,
available.
that doesn't count,
Um,
Jonathan.
yeah,
That doesn't count.
but in terms of the original pool, which Dustin was talking about last week, was 65% loan to value, multifamilies, and they were kind of filled up too quick. They went a little more conservative now because they realized that the market need and request was too big. So I'm starting to see them turn. They immediately at the start of this week issued out new guidance for us, and now the new guidance is a 60% loan to value, 30-year
Okay.
fixed, which again 40% down. It's you're putting yourself in a pretty good long term spot, right?
Right.
Um, and then no more multifamily, so 2 to 4 units not
Gone.
in the mix anymore. It's going to be only single families, warrantable condos and townhomes.
Okay.
Single families with permitted ADU, like one
Okay.
permitted ADU
Yep.
is okay.
Okay.
If it's not permitted, not okay. And then minimum loan amount is 150. So
Yeah,
so
this is really interesting because this is frankly exactly what I thought would happen, right? We had a fund come out being aggressive. Again, I pontificated. They had some capital that had a short clock on it, so they wanted to deploy it. They took a shot at being, buying the market. They did buy the market successfully, and they're like, "Oh my God, too much demand. Let's tighten this up a little bit." And again, their whole goal is to lend this money at a point below conventional, but they want to be safe. So it makes total sense. They went from 65 to 60. They went from multi to singles. Um, minimum 150. Because again, they want these loans to be good, and they want them to not be refied out. That's what they're doing.
exactly. And here's what I'm recommending to clients now is if you get in that program, let's say you just make the extra commitment of let me put 40% down to buy this property, just to make sure it cash flows well and
Mhm.
performs well. Later on, we have a DSCR second that would actually look pretty good behind this
Mhm.
first because in the current rate market environment, like investment real estate with a five handle is not that common. So if
Mhm.
you needed extra capital later on, that equity is not debt equity because you're
Right.
buying it with a certain level of cash flow. Your debt coverage ratio at 40% down, if you're buying a single family or condo or put, should be at least 1.25, right?
Oh, at least.
1.2,
Yeah.
1.3, right? So if that's the case, then you can add that into the second in the back end. If you really need that capital later, right? You have that opportunity. It's not dead. You don't need to refi the whole thing. And then later on down the road, and maybe not this year, but maybe next year or the year after, when rates actually do start to make a significant decrease down, you can refinance the whole thing and kind of consolidate there.
Yeah. Well, something I was curious about, again, once we have one money fund come out and kind of buy the market, get ahead of it, sometimes competition heats up. I'm curious if you are hearing of other funds kind of getting ahead of the game. We actually have seen the 10-year note fall 50 basis points in the last couple of weeks. Mortgages are down about 30 basis points. But I'm curious, are more Wall Street money funds trying to get ahead of the game because they see rates coming down, or is this still a one-off?
This is actually still a one-off because if
Okay.
you look back at our channel, and this is for the people that have been following us for a long time, the non-QM market doesn't react necessarily
Mm.
immediately to a market shift, right? So this was actually planned already and kind of teased to us and then rolled out
Mhm.
like weeks ago, right? And months ago. Which is why Dustin said he couldn't hold it back anymore. And because it was starting to get available, he wanted to announce it because
Right.
um, this is something that was already planned. So they already had an allocated amount, right, of money that they wanted, a
Mhm.
tranche of money that they wanted to kind of allocate and secure. That's, kind of what they're doing. Everyone else on the market, I think, still like the lowest that you can get on DSCR is like the low sixes. So
Okay.
that's kind of, it's still like, okay. And I'm talking to a lot of clients that now are kind of being like, I want to buy it down to the furthest rate and just hold it for
Right.
a long time for their
Mhm.
long-term holds, which I think is a good idea, especially in this market with opportunities kind of coming up, better deals to kind of make offers on, better purchases to make with margins that you build in up front, right? When, like, you're buying it for 1-1, but it's worth 1-3 or something, right? Where there's a extra margin built in. It's a great opportunity to make use of that money. So now, if you can make greater than, call it, a 6.5% return on the cash that you pull out, then you're going to be okay putting that towards a separate property and expanding your portfolio while everyone else is kind of just waiting for mortgage rates to fall.
Yeah, it's going to be interesting. So again, still a very much a one-off, but you've kind of opened the door. I'm going to call it opening a window for me. So since you basically hinted that this money fund has been talking to you for months ahead of time before the public announcement, that leads me to ask one question. Are other money funds whispering in your ear, giving you the inside track to other exciting things that may come out in the next 4, 6, 8 weeks? Jonathan, you open the window. I got to come in, man. Is more stuff coming?
There is more stuff coming. There's stuff that we can't talk about yet, but there is a shift in the market, and I've been telling clients this recently in terms of just DSCR in general and the non-QM market in general. Um, it's going to be an interesting path forward, right? Because how is conventional going to do versus non-QM buckets, right? How is Fannie, Freddie, FHA going to perform with their loans? How's their default rates going to be? How is that going to happen and going forward? Is that going to be the same track on the non-QM market? Because if default rates, which unfortunately I've been getting a lot more notices of it slightly ticking up on the non-QM side,
Sure, of
um,
course.
if those default rates continue to increase, then how is that going to shift the way that the rates are moving in the non-QM? We might see a total inverse of, like,
Yep.
all of a sudden, even though rates drop, let's say the federal funds rate and the 10-year treasury and the 5 years, all of that drops, we could see non-QM rates go up, right? Depending on how that securitization is working. Because a
Yep.
lot of the defaults that are coming out now were Airbnbs, that's
Yes.
still rolling through. Like,
Yep.
Airbnb loans have been probably the highest
Oh, the
defaulting
worst
loan
performer.
in
Worst performer.
in yeah, in all of the market, right? And especially a lot of clients that bought with very, very little margin in terms of cash flow, right? They're not even breaking even. They bought an alligator, as you might say.
Mhm.
And
Exactly.
because they bought that, they can't carry now the payments. It's 3 years of payments that they've carried, right? So
Yeah.
they were carrying, it was like 1 year, $300, not a big deal, 3,600, and then it multiplied. Now it's times two. Now it's times three. Next year will be times four. So, like, how
Yeah.
much further can they carry this negative through? Because if you're working a W-2 job, your wage hasn't gone up the same amount as your negative cash flow has been able to fill. So that's kind of, I think, where the interesting next bucket is going to be, and where I'm getting a lot of whispers on defaults is any property that was bought with a negative debt coverage ratio, right? That
Yeah.
has a 5-year prepay on it. Because some people did that, right? They bought it on 0.5 DSCR, 0.6
Ooh.
DSCR. And if you bought it at those DSCR rates, and, like in California, you can't evict people, you can't, kick people out, your cash flow is still negative. That's what's hurting the apartment market a lot too, right? In in
Mhm.
in the LA market, everyone that was in these adjustable rates that went 3 to 5 years ago were buying them, expecting them to be able to kick them out. But the rules got harder to evict people and move people out of the home. So now they're carrying a negative carry for even further, and I think that's what's kind of starting to happen. And the rumblings that we're starting to hear as a trickle down effect from the commercial apartments down to
Yeah.
multifamily, like 2 to 4 units. From what we're hearing.
Yeah, I think it's gonna be a really interesting year. I think extend and pretend is just about over. We're gonna see it very much in the short-term rental game. Again, I think a lot of deals were bought in 2020, 21, 22 that just don't make sense in today's world. That, again, alligators are real. It's why it's in the only picture in my first book. You don't buy those ever, because you have the market could turn and you got to carry this beast that's just constantly eating. But also the commercial, class B and class C multifamily, there's a lot of syndicators that are they're raising pref equity, and they're doing all these things to try to escape. But a bad deal is a bad deal. And I think a lot of losses are coming there. But let's switch gears. Something else you brought to us, I think 2 or 3 weeks ago, is you had this product, sub 8% bridge loans. What the heck is this? Sub
Yeah,
8?
it's crazy. It is probably the most aggressively priced bridge loan that is on the market today.
Yeah, I would think so.
Yeah, 12 to 18 month, 799, no prepay, bridge loans at 85 to 90% loan to cost, depending on experience, credit, liquidity, all that. So that, if you think about it, right, and this is, I say this with a little bit of careful, tread carefully here. But if you think about it in the sense of, if you're buying an investment property and you know that you're going to be exiting, whether it's a refi or a sale in the next year, right? This may not be a bad alternative to call it a DSCR loan with a 0 or a 1-year prepay, right?
I agree. If you knew with certainty that you were out
Mhm.
in 12 months, this makes a lot of sense, especially at 85 or 90% loan to cost. That is amazing leverage in speed. That's pretty good.
Yeah. Yeah. So, um, to clarify, just for anyone new, loan to cost is purchase price plus the budget or the cost of construction or rehab. And then that percentage of that is the total. So if I say 85% is pretty safe to run, if you have a couple things under your belt, right? Then 85% of, call it 500, call it purchase price, 500 budget. That's $1 million total. 85% of that would be the total loan amount of 850,000, right? So
Yeah.
just to make sure that everyone's clear, it doesn't mean that you're actually bringing only 15% down to buy the property. It means you're doing 15% down of the entire project. Yeah.
Correct. And this is why it's important to have experience and track record, why you're going to get, a larger loan if you have experience, documentable experience. But again, at the end of the day, Convoy Home Loans is always out there looking for new and exciting loan options. You guys provide both conventional DSCR and all things to the One Rental at a Time family. Where should people go if they want to initiate a conversation?
Go to convoyhomeloans.com and let us know you came from ORaaT. One last point, actually, I saw it this morning and I locked my client in, conventional loan. I wanted to talk about it.
Yeah, go for it.
So it's a primary home, 25% down, high balance, and we locked in at 6.6 without buying down. That's like 0, and then but technically we could be locked in. Like, he wanted more of his closing costs covered with credit,
Mhm.
but if he wanted to just take it, at par, it would have been like a 6.3,
Oh
six
my
five
God.
on a primary residence. So it's we're now back in that market for primary, especially. I think investment has a little bit of a bigger spread and hit still,
Sure.
but
Yeah, yeah.
like DSCR average is sitting between 649 to 675 ish, right, in that realm for 25% down, 30% down. So it's pretty comparable to conventional,
Hmm.
and if you're looking at it from this perspective, like, obviously DSCR is a prepay, but you're looking at a 649, 675 on a DSCR loan, and then you're looking at a 6.5, 6.3 on a primary. That spread's really, really small right now, just because it
Sure.
hasn't moved. So just encouraging people to look at, all the options, conventional, DSCR, and all that. Yeah.
Folks, that's why you got to go to Convoy Home Loans. They do provide the options. They'll let you choose. They'll tell you the ins and the outs and the differences. Again, go to convoyhomeloans.com, little drop down, say one rental at a time. And the beauty of doing that is you get this young man or his partner, Dustin. If you don't do that, you're just going to end up in the queue with all the plebes, and you're not a plebe. If you follow one rental at a time, talk to the guys at the top. Thanks, Jonathan.
Thank you.